Yeah, and here this table illustrates how CVA can be managed within the trading department of a bank. That's it. Thank you for your attention.
Thank you. Are there any questions? No? Okay. So thank you. See you later.
Thank you. Thank you. Bye-bye.
Bye. Okay, so I call Daka Mamadov. Daka? Okay. Okay.
Hi, everyone.
Please show us your ID. Okay. So Daka Mamadov.
Can you hear me?
Yes, Daka Mamadov is going to discuss a thesis under my supervision, whose title is A Relationship Between Stock Market Return and Weather Anomalies, a case study of Italian Bourse.
So I'm sorry. Can you see me my screen?
No.
No. No. Sorry.
Try again.
Now?
Yes. Yes.
Thank you so much. My name is Zakir Mamadov. I'm from Azerbaijan. Today I am going to talk about the relationship between stock market returns and the weather anomalies. And finally, we will summarize and we will check whether if there is a relationship between these variables for Italian bourse. Now we will talk about the test outline a little bit. Briefly, we will talk about the introduction. Then we will give about the background, how this relationship has evolved over time, and why we decided to. What is the motivation behind this relationship? Then we will talk about the previous studies made until now. And you will see that there is a extant literature regarding this topic. Then we will talk about the data collection and methodological framework, which variables we have used, which data is what type of data sets we have used, and which type of tests and methods are conducted to summarize the existence of and to check the existence of this relationship. Finally, we will talk about the results and discuss about the results of these tests separately. And finally, we will conclude and give recommendations for further research. And we will briefly talk about the limitations of this case study. From background perspective, we can say that the fundamental theories behind the economics are the consumer theories, rationality, but the recent studies shows that the psychological aspects and have also an impact over the human mood and hereby the decisions of investors decisions and step by step their returns. As an interdisciplinary field of neuroeconomics, we can say that it is proved that the weather has an indirect impact over humans' mood and thereby their decisions. It has been proved that the high temperature leads to aggression and apathy, but low temperatures leads to aggression. What this means? This means that aggression and apathy are related to risk aversion and risk taking. This means that risk, as far as the temperatures are getting high under extreme weather conditions, investors are taking more risk. That's why there should be some relationship between those variables, and we will see that this relation exists, but not for a long time. What is the motivation behind this thesis? When I have researched this relationship, namely weather anomalies and stock returns, I have seen that the most of results gave positive positive. What do I mean? There is a statistically significant proof relation between those variables, stock returns and Weser anomalies. And we will define what do we mean by saying Weser anomalies. We will use the average daily temperature. And why I used the Italy for conducting test. As you will see, the most of markets which this test has been conducted for are developing countries. But it, as a member of European country and as the recent climate change exists for Italy, and also economic phases in Italy, tells us that we can test and conduct the result. Possible use of results can be useful. The results can be useful for regulatory authorities because if this relationship exists for investors, it means that there is an arbitrage opportunity to beat the market. And it affects the efficiency of market. So it means that the market which the tests are used for is not efficient enough, at least in a weak sense. So there is an arbitrage opportunity which has been conducted. From now on, we will see the 4 parts of thesis. We will talk about briefly the literature review. Actually, the literature review is very extent, but I will not stuck over the literature review and talk briefly about the results. And then we will talk about the technical parts of thesis: data collection, methodology, results, data analysis, which type of tests have been used, and finally we will summarize and give recommendations for further research. This is the typical climate chart for Italy. As you see, the amount of rainfall are typical for winter months, but the average daily temperature are high for summer months, as it is usual for Italian climate. So, regarding literature review, we can see in this slide that the literature review tells us some of the results are positive. Actually, the most of the results are positive, and the authors conducted different tests. Different authors conducted for different tests for different markets and different weather data. Some of them used daily average temperature. Some of them used the cloud cover. Of course, this is also proof that the cloud cover, which also determines the amount of sunlight, has an impact over human mood, and therefore over his risk aversion and risk-taking ability. Let's say Hoffman in 1984 says that there is a positive. The humans are actually are not able to perform some tasks over the extreme weather conditions. What do we mean by extreme conditions? We say extremely high or low temperatures. For example, but he also comments that the region, the area where the people live, let's say Scandinavia or deserts, the extreme weather conditions are usual for these people. That's why their impact will not be the same with the people, with the investors who live in normal conditions. Also, the Haschleifer and Shanwei also defends this proposal. One of these tests conducted over 6,000 Asian markets, but they conducted that test and decided that. Here Gerlach in 2007 he conducted test and said that the investors and the investors' returns, also the stock prices, are responsive to macroeconomic events, recent macroeconomic news events, rather than weather-related variables. As you will see, these are exceptions. So also, from the local or foreign perspective of traders, Kang, Zhang, and Li also conducted the test for foreign and local traders separately, and then their hypothesis was that the weather will not have effect for foreign traders because they are not affected by weather conditions. but the test shows the reverse, and the effect for both local and foreign traders were same, but the prices for local market were more volatile. Also, some authors used not only the test effect of Weser anomalies over the stock returns, but for volatility of the market, which also determines the price of stock and return of investors according to return risk and return perspective. So most of the tests, which also use gauge effects, also the authors who conducted the Glatten-Jagannathan-Rankel bound gauge process, they assessed and decided that Weser related variables are useful to assess stock processes. Finally, the most recent tests, which are the Tufan and Hamarat also made tests for Turkey, but the result was negative. They actually included the cloud cover and the amount of sunlight, but the test result was negative. Also, the last year, Wang and Zheng also tried test for forex market. Forex market is considered to be less efficient than stock market, so it was thought that there should be a relationship between those variables in this market. But the test was negative, and they decided that there are some other factors that should be taken into account. From now on, we will talk about the technical side of thesis. The aim of this thesis, this case study, is to check whether is there any relationship between Weser anomalies, Weser related variables, and stock returns of Italian market. And to represent the Italian financial market, we took the Milan Stock Exchange, in other words, FTSE MIB, Milan Stock Market Index data. To conduct such type of test, we collected two type of variable, two data set. One is Weser data, and one is stock market price. And of course, it's also agreed that the stock prices are not stationary, and that's why not them, but returns which is recovered from them are regressed over the variables in econometric models, which we will also conduct. To collect the data, actually for general purposes, we use three softwares: Python, RStudio, and Microsoft Excel to manipulate the data. To get the Weser data is not easy task, because there were so many data providers, and it took time to check the data and to be reliable about the data. And we used the web scraping technique, which via the module of Python, Beautiful Soup, which helped me to collect the data from the website easily. But for the stock market prices, it was easy, and it can easily get from Yahoo Finance in Excel format. About the methodological framework, as you will see, we will calculate some statistical metrics, namely stock returns, variance of returns, and the percentage of positive returns. And then we will use the tests to analyze if there is a relationship between these variables or not. What does bean test mean? We will talk about this difference. Also, to conduct the test, we first collected the data regarding Weser from 2017 until 2020, end of 2020, and we then arranged it in an ascending order. Then we divided data into four space, like four cluster. The first and fourth bean represent exactly the lowest and highest temperatures respectively. What this means, these beans are representative for extreme weather conditions. And for each of these date, we have stock price. Not for each date, but as the Italian financial market is open for some dates, after merging the data, we had around 950 observations, which was enough to conduct the test and get a reliable result. So some type of test like difference in stock returns, difference between means and percentage of positive returns have also been conducted, but these are not, they say about the correlation between variables, but there is no any predictive power to predict the variable, to regress any variable using the dependent and independent variable. We conducted also ordinary least squared regression. So the results. The results summarize here the 4 types of tests. First of all, the bean test, regression. Then we checked the robustness of results to data. We will talk about it. And we have also modified the data, modified the model, and check if there exists any relation or not. As you will see, from now on, you will see some visual charts and statistical results, which tells us about the, for example, here we can say that here the just descriptive statistics of variables are represented, and formulas which are used to assess the test and to calculate the test statistic are represented here. Here, the scatter plots generally between intraday return and average temperature is plotted. Then for extreme weather conditions, in other words, bean 1 and bean 4. Also, to check the relation between beans, their box plots have also been plotted. And for the regression purposes, we use 2 models, which we will talk about in recent slides, in future slides. Sorry, in the next slides. After plotting the residuals, we will see that, for example, after conducting the bean test, as I talked about it, we decided to arrange the data in an ascending order and test if there is a difference between mean of the stock returns between extreme weather conditions, extreme weather beans like first and fourth bean. But the result here shows that, yes, in the table 6 table, the data shows that the p-values for return mean and percentage of positive returns is not statistically significant. So the hypothesis testing, the null hypothesis is accepted, and there is not any proof that to claim there is a difference between their means. Also, using the visual graphs, we can also see that from the scatter plot, there is no typical pattern between average temperatures and intraday returns. As far as the regression results, first of all, we conducted the return is a regressant, is a dependent variable, and because it is financial data, there is also proof that financial data sometimes shows an autocorrelated pattern. That's why we also put this variable into the model. And also there is also belief that Monday has there's a Monday effect over the stock return, stock price, which we also used as a dummy variable. And
sorry, Zaka, to interrupt you, but I must invite you to the conclusion of our limited talk.
Okay, I'm sorry. I will briefly conclude about the results of these models and conclusion. The variable of interest, which is temperature, gave us that there is not any relationship between stock returns for Italian market, and Vese variables. As you will see from the tables, the p-values is not statistically significant. Only from the table 11th table, you can see that when we conducted test for second model, when we conducted also, when we also included temperature and yesterday's temperature into the model the day before the date, and we can see that there is a weak relationship. Also, the p-values are not statistically significant at 10% level, but there is a weak relationship between those variables. And here you can see the results. We also made sensitivity analysis. I divided the period into two periods: pre-COVID and COVID. After COVID period, I mean, not after COVID, but during COVID period. Stock returns to check whether the COVID has an effect over stock returns, and is there any different pattern between different relation between Vese anomalies and stock returns. But the result was the same. But here from the 15th table, you can see that in the pre-COVID period, returns showed the autocorrelated matter. And finally, I would like to conclude and give some recommendations about the study. The aim of this thesis was to address the issue of determining this relationship, but the result for Italian market was negative. What this means? This means that there may be some assumptions about this result, negative result. First of all, about the market efficiency. Italian market is may be efficient in a weak sense, so that the stock returns of Milan Bourse is not related to Vese variables. Also, it may also be argued that the daily temperature is not a very good proxy or as a representative of weather. That's why we can use some other variables like humidity, cloud cover, the amount of sunlight to check this relationship, to check the existence of this relationship. Also, about the model specification, as you see, we have used linear regression, but the econometric model may be in different sense, like quadratic on in other mathematical form. But the results from bin test, which gave us that there is not any type of correlation, there is not any difference between the stock returns of beans, tells us that there is no any misspecification from model. And about the limitations of the studies, sample size may be large, and other Vese anomalies, as mentioned earlier, can be used with mood variables, mood affecting variables, not with just Vese anomalies, but with other variables. This case study can be tested for Italian market again. And it's also considered here that investors are always rational, but this is not always the case. For further research, we can say that level of frequency also cannot be daily. Maybe for minutes or like less frequent, more frequent data can also be used, which is possible to collect by institutions. Also with mood variables, and also the machine learning algorithm, the recently developing machine learning algorithms, which is the subfield of artificial intelligence, can also be used, not just econometric model, to assess and to check the existence of this relationship. Thanks for your attention.
Thank you.
I'm ready for your questions.
Any questions?
No.
No. Okay. Thank you.
Thank
you. Well, I call the next student, that's Andrea Saverio Rotolo.
Yes.
Good morning.
Good morning.
Thank
This
you.
is my idea.
Yeah. Okay. Thank you. It's fine. So Andrea Saverio Rotoli to discuss the supervision of Professor Guistardi, whose title is Detection of Bitcoin Trading Signals with the Multi-Layer Perceptron. You can share your screen.
Yes.
Okay.
Okay, so the general outline of this presentation is this. So I start with a brief introduction to the topic and then to neural networks, and then more space is left regarding the experiment and results sections. So the general topic is the application of the multi-layer perceptron model. In particular, I will apply this model to forecast the intraday direction of the Bitcoin returns. In literature, apparently these models are very used to forecast in the intraday Bitcoin market. However, when trading systems are built on this forecast, transaction costs are not always properly considered. So I wanted to investigate further on this research area by trying some new features, by evaluating the forecasting ability of these models with simpler ones, and then by checking realistic trading profitability of a trading system based on it. So the artificial neuron is the basic unit block of a neural network. There are some inputs that are weighted and transformed with an activation function. The multi-layer perceptron is a feed-forward architecture where neurons are organized in layers and each layer is connected forward to the next one. Thanks to their structure and the use of nonlinear activations, they can be used to model nonlinear and complex functions. Now, learning, it consists in adjusting the weights. Usually we use a gradient descendant technique. However, the cost function is not convex, and for this reason, we may want to start the training with the different initial weights to reach a local minimum. Then also this model are trained in combination with a generalization technique, since they are very prone to overfitting. So in our experiment, we will assume to be a trader that will trade on a 15 minutes time frame. And therefore, he will need to constantly update his tools. But on the other side, neural networks can be very time consuming to optimize. For this reason, I gathered some of the tools that can be used to speed up the learning procedures. So mini-batch is a sampling technique with which we take a random subsample of the training observation to find a stochastic approximation of the true gradient. The stochastic approximation helps us to escape from local minimum, and in general this algorithm is it has been shown to be more effective than traditional stochastic descendant, since it is more computationally efficient. Then there are also some faster optimizers like adaptive moment estimation, where we use the exponential moving average of the exponential moving standard deviation of the past gradients to adjust the learning step. And then there are also some initialization technique like Laurea initialization, which had proved to lead to a faster convergence than just random initializations. So in our experiment, we had a dataset of 50,000 observations that we divided into training, validation, and test samples. As input for our multi-layer perception, we use some technical indicators, which are assumed in this table, and then as a target, we try to explain the direction of 50 minutes Bitcoin returns. We use three classes: negative, neutral, and positive, which will correspond to a position in the trading simulation. So we specify a 18 different architectures by varying the number of inputs, hidden layers, and hidden neurons. And we try to invest more on the information capability of the inputs by including a selection of the features and an addition of exogenous variables from the Forex market. Then we use as a generalization technique early stopping. With early stopping, we monitor a set of observation which is not used during training to get an approximation of the generalization error and to halt the training when the validation error stops to decrease. Then, to select the best performant architecture, we use a personalized metric, the custom weighted accuracy, which is an in-between a continuous and per class metric. In this way, we could consider the distance between the three directional classes. In the image below, there is a small example of how it works. If we want to explain the positive direction, but our model is wrong, then we want to give more penalty if our model negatively wrongly predicts the negative class. And if our model is less wrong by predicting the neutral class, then we want to give less penalty. Then the final metric is given by the simple average of the premium and losses among the validation observations. Then, to estimate the final model, we ranked all different architecture with our custom metric, and we found out that most relevant topology feature is the input that we fed to the network and not the hidden structure in particular, both the feature selection and the addition of exogenous variables determine a worsen performance of the models. Then we run some model evaluation with some simpler models. We use a naive model, a biennial, and an exponential moving average crossover. With the superior predictive ability test, we tested the null hypothesis that one model in turn has a superior predictive ability than all the other alternatives. This null hypothesis can be rejected for the simpler models with these p-values, but not for the multilayer perceptron. So these results seem to suggest that our model is superior to the simpler ones. So finally, we run some trading simulations. If we don't consider transaction cost, we have that multilayer perceptron strategy reach an asset value process which is higher than the other benchmarks. We also get the higher return risk ratios and a win ratio of 67%. So this means that in 77% of the trades, we will get a positive return, a positive gain. And however, if we consider full transaction cost, we can see that we obtain an asset value process that exponentially decreases towards zero. This is due to the fact that transaction costs in Bitcoin market are very elevated. And for this reason, there is some information which was provided by the multilayer perceptron, which we could not use since the average gains of the trading system were lower, much lower than the expected cost. So finally, we tried some alternative approaches in using our multilayer perceptron signals. In particular, we tried to filter out the weakest signals, since the output of our multilayer perceptron was a probability vector. we use some threshold to decide whether to consider a certain signal valid or not. And also we tried some hybrid strategies where we use the multilayer perceptron as a confirmation for the exponential moving average crossover, which is a longer term trading strategy. And so we had less trades. However, in all these approaches, a simple buy and hold was more effective than the other strategies. So at the end, we can say that in our experiment, the input turned out to be the most relevant features. The multilayer perceptron gave the best 15 minutes forecast. However, there were too elevated transaction fees, and therefore we could not use our model to build a profitable trading system. We also tried some alternative approaches. However, still a buy and hold turned out to be more profitable. And so at the end, we can say that we don't have any proof that our multilayer perceptron can be useful for a trader, and further research is needed. And for example, in further research, we may use more hybrid strategies where we use the multilayer perceptron as confirmation for more effective longer-term trading strategies. So I finished.
Thank you. Are there any questions?
I have a question, but is a challenging question. So you study a market with high volatility, high frequency data, and so you probably we expect to find out that the multilayer perceptron is the panacea of all the possible model. Okay, so because all the characteristics, the expected characteristic for machine learning to work are in our experiment. What's wrong? What's wrong? Why we didn't have, good results?
So okay, the problem was with the transaction fees. So the multilayer perceptron is able to get some information from the input.
Andrea, sorry, I understood about the transaction fee, but why there are a lot of articles in the a lot of papers on that said that multilayer perceptron works, and we find out that this problem. Do you think that other people do not consider transaction cost, or what are your opinions?
Yes, this is due to the fact that in most researches they don't consider transaction costs, and for this reason there is a huge bias in literature, and simply because only positive papers are published, and they try to avoid these negative aspects.
Okay.
Okay, other questions? No? Okay, so Andrea Saverio, see you later. Okay. So we go on with the next candidate. I call Simone Settimo.
Yes, can you hear me?
Yes, we can. Thank you. Okay, Simone Settimo is going to discuss a thesis under the supervision of Professor Lamandini, whose title is A Digital Euro for Everyone, the cryptocurrency project of the European Central Bank. So the floor is yours.
Yes, I'm trying to sharing my screen.
Yes.
Does it work?
No.
Not yet. I'm trying.
You know where it is.
Yeah,
Right hand
just
side on the
just
top,
the computer.
close to the bottom where it is written leave. On the right hand side up.
Is loading, but
Okay.
he cannot access the desktop. Share content.
No.
I'm having problem. I'm sorry.
You can try copying your slide in the chat. And then I can share my screen.
Yeah.
Simone, if you want to send your slides to me, then I can try from my screen.
Yeah.
Okay. I'm going to send on the chat.
Well, actually, can you send it through the email, to my email?
I think that you already have them because I sent them previously.
Well, I checked right now, but actually I was unable to find. Well, I'll do a second check. Wait.
Okay, they are available on the chat.
Yeah. Yes, but I cannot open your slide. I don't know why.
I don't know.
I don't know, but
I'm so sorry. I'm trying to sharing the screen again because I do share content, but he is loading, but nothing happens. What I could try to do is to try to change computer and try from another one from Windows, because now I'm on.
Did you send your slide to Professor Lamandini? Because this may be the best solution.
Yes, I can.
Well, actually, I found them meanwhile, so I'm trying now to upload them. Let's see. Perhaps it comes. It is uploading it.
No.
No.
But apparently it takes quite a while because actually it is still in the middle of the process.
Okay.
It started very quickly, but then it stopped.
I don't know what's the problem.
How heavy is your file?
It may come now. It may come.
Yeah. Yes.
Yeah, I see it. Okay, yes.
Here I am.
Yeah, finally. Yeah.
Loading.
Now the floor is yours. And then I will try to follow you. And actually, if you ask me to actually go on, I will move on the slides.
Okay. Can Can you see the slide entirely? Because mine is cut in half.
No, I see them full screen perfectly.
Me too,
Yeah.
me too.
Yes, you can start.
Yeah, you can start.
Okay, yes. So now I can start. First of all, I would like to say that I'm pleased to see that previously my colleague developed a topic based on cryptocurrencies. So my thesis also is related to cryptocurrencies, but the focus here will be on a central bank digital currency. There is a little bit different. Central bank digital currencies have been the subject of much debate recently. Central bank money in the form of cash, reserves and settlements account is today the safest means of payment for retail and wholesale transactions. You can please change the slide.
Do you see the next slide?
Okay, now I see it.
Okay, great.
Okay, if you give a click, okay, so however, the use of cash is declining in several jurisdictions due to the digitalization of payments and the current COVID-19 pandemic. Furthermore, private cryptocurrencies such as the Bitcoin are gaining acceptance among citizens as a new means of payment, and stablecoin initiatives are entering the field, issued by big tech companies such as Facebook, who is implementing a Libra cryptocurrency. If stable coins and the cryptocurrency replaced central bank money, then cash and central bank deposit would lose acceptance as a means of payment and a store of value, hampering the monetary sovereignty and the financial stability of jurisdictions. Against this background, central banks around the clock are then assessing whether to issue their own central bank digital currency. The People's Bank of China is experimenting the issuance of a digital one. The Swedish Central Bank is working on the krona, and the European Central Bank is entering the field with the digital euro. So the purpose of today's presentation is to clarify the notion of central bank digital currency in order to show the feasibility of the digital euro project, and also evaluate the challenges for the euro system. Anyway, I'm able to control the the presentation now.
Very good. Very good.
Do you see popping up the images?
Well, actually, I'm seeing what the digital euro is. So I'm still at slide number 3.
No, I'm at slide number 2, actually, the introduction one.
Okay.
Previously.
So now, perhaps also our colleagues are now seeing slide number 2, but beforehand we had slide number 3. So my fault.
Yeah.
So here we are. At the moment, we are slide number 2, introduction.
Good. So when you move on, I will move on the slides, but please tell me slide 3, slide 4, and so on, so I can assist you better.
Okay. Now you are at slide 2.
Correct.
So you see the images and the and the written part?
Yes, both.
Okay, so now we can switch to slide 3, where what a digital euro is. So here I'm going to define the notion of central bank digital currency and therefore of digital euro. If you click, it will pop up the definition of digital euro. According to the European Central Bank, a digital euro would be a digital form of the euro system liability. It would be used for retail transactions, and it would complement and not replace euro banknote and central bank deposit. Therefore, the digital euro would be a digital equivalent of cash, and it would be convertible at par with other forms of the euro. If you click now, you will see the benefits of a central bank digital currency. First of all, it would help the euro system to provide citizens with riskless money in a scenario of cash discontinuation, and also to address sovereignty and financial stability concerns related to private digital means of payment that cannot be labeled as legal money. If we go to the next slide, slide 4, the digital euro pyramid, here it is important to understand the process leading to a central bank digital currency design choices. If we click, we could see that a first type of decision consists in assessing whether to issue a digital euro as a claim on the euro system or as a claim on a supervised intermediary transacting on its client behalf. With another click at the second layer of the pyramid, we can see we can analyze how a transaction could be recorded either in the Eurosystem ledger or by means of a distributed ledger technology. A distributed ledger technology is a database for the record and the settlement of transactions without the involvement of a central counterparty. With another click, we can notice how, depending on the infrastructural model, a digital euro could be issued as a token-based payment instrument similar to cash, or as an account-based one, sharing the same properties of commercial bank deposits at the central bank. With another click, we get to the top of our pyramid, where the euro system would have to assess whether to make the digital euro cross-border. So it would need to evaluate its interoperability with other central bank digital currencies and the impact on the cross-border spillovers of monetary policy shocks. If we go to the next slide now, slide number 5, the research, and if we click as well, the research distinguishes between two infrastructural models, a centralized ledger and a decentralized ledger. With another click, we could implement a digital euro through a direct approach, according to which, by clicking again, a digital euro would be a claim on the euro system handling retail payments. In the indirect model, so if we click again, the digital euro would be a claim on a supervised intermediary transacting in its client behalf. with another click, the digital euro developed in a centralized ledger could be implemented by means of account open at the European Central Bank or at the relevant national central bank. On the other hand, in a decentralized ledger, the digital euro would be a direct claim on the euro system. But if we click, we can see that, if we click actually 2 times, we can see that the direct digital euro would allow end user to transact among each other without the involvement of an intermediary. Clicking again, we can notice how they will be equipped with digital wallets and private keys for digitally signing their transactions. In the case of a hybrid digital euro, instead, if we click, we can notice that the euro system would be involved recording the total amount of retail transactions, while intermediaries would transact and record payments in their client behalf and pledge money at the central bank against the issuance of digital euro units. So if we go to the next slide, a decentralized ledger brings me to explain how central bank money can be represented and also transferred in a digital environment. If we click, we can notice how by gathering together informations on the Jasper project of the Bank of Canada and the Stella project of the Bank of Japan, central bank digital currency units can be identified by and transferred as states. My assumption is based on a Corda platform. In this platform, a state is a immutable object containing any information on the ownership, value, and cryptographic validity of the currency. An example is the digital repository receipt, which is a digital representation of central bank money used for wholesale transactions, so interbank payments, which shares the same functionalities of cash in a DLT platform. If we click again, we can, it's explained how a transaction is recorded in a distributed ledger environment. Here, a transaction is settled when consensus is reached among multiple nodes. This means that transacting participants would have to exchange and digitally sign a DDR object, and a notary node, usually represented by the central bank or an autonomous third party, would be involved in checking the uniqueness of the transaction. If we go to the next slide, what type of digital euro, here it is explained how, according to the infrastructural model that is chosen, a digital euro could be issued in 2 types of way. If we click once, it would be an account-based digital euro. It would be implemented by accounts open at the euro system with the central bank or a supervised intermediary entitled of checking the identity of any central bank digital currency holder. However, by clicking again, an account-based central bank digital currency is not a digital equivalent of banknotes. Therefore, if we click again, a tokenized version could be implemented. In this case, any participants will be equipped with digital wallets and would be able to transact in a distributed ledger environment. If we go to the next slide, depending on the type of digital euro, the euro system would face different challenges. Here I'm going to focus on two aspects: the remuneration of a central bank digital currency and its privacy requirements. If we click once, we can notice how the remuneration a digital euro could be issued as a non-interest bearing payment instrument similar to cash, or as a remunerated one. By clicking another time, it is noticeable how in both cases, in a scenario of financial stress, a digital euro would entail a large substitution effect on commercial bank deposits, leading, therefore, to digital runs and bank disintermediation. If we click again, the euro system would need to find solutions. For example, it could set a threshold on central bank digital currency holdings, above which the interest rate applied to a central bank digital currency could be made less attractive, or it could be also set at 0. If we click again, for what concerns the privacy requirements, the euro system would need to find a balance between strong identities tied to an account-based payment instrument and the full anonymity in transactions provided by a cash-like one. However, if we click again, the current European regulation does not allow anonymity in electronic payments, in order also to address anti-money laundering and counter financial terrorism concerns. Therefore, the euro system would have to step in by checking the identity of participants during the onboarding phase, while allowing for different degrees of privacy through a selective approach or auditing by third parties. Finally, my next slide is on the cross-border implication of a central bank digital currency. In particular, by clicking, we can see that a central bank digital currency amplifies the international spillovers of monetary and technology shocks, increasing international linkages. Clicking again, the reason can be found on the study by Stracca at the European Central Bank, which extends the two-country DSG model of H&BOM. If we click again among the assumption of the H&BOM model, we can see how Stracca introduces a new asset, the central bank digital currency, which is a hybrid instrument. It is remunerated, risk-free, it provides liquidity services, and it does not have storage costs. By clicking again, it is shown how the model creates a new arbitrage condition, according to which the risk-free rate in the foreign economy can be expressed as a markup, which is the term in the squared parentheses, on the remuneration of the central bank digital currency. This means that the presence of the markup makes risk-free rate movements in the foreign economy much stronger than they would be in a scenario without a central bank digital currency. And the short-term equilibrium is reached at the cost of larger exchange rate adjustments. If we click again, we can see how the Eurosystem would need to minimize these international spillovers. How? For example, by introducing conditions for access and use by non-euro area residents, by making digital euro connected with other central bank digital currencies, or by applying a flexible interest rate. Finally, my last slide, it's about conclusions. So what has this presentation proven us today? If we click, we can see that it has shown us how in a digital world, while there is currently no need of a digital euro, the future survival of the currency would probably depend on the issuance of a central bank digital currency. By clicking again, research has defined a digital euro as a digital form of central bank money issued to citizens and firms and complementing cash. The analysis of design choices and the challenges of a digital euro suggests how the Eurosystem would need to take into account a trade-off between positives and negatives of a euro crypto cash and a deposit-like instrument. However, regardless the type of digital euro and its infrastructure, it is crucial that the Eurosystem always control the life cycle of the central bank digital currency, from its issuance to its redemptions, in order to serve the efficiency of retail payments without compromising the monetary order and the financial stability in the euro area. Thank you. Thank you.
Good, Simone.
I hope that
I'm fine with your presentation. I don't know whether there are questions.
Everything is clear for me.
No, no questions. Thank you.
I hope that it worked well.
Yeah.
It has been a little bit long, but it was not your fault. So good, thanks. We move on.
Thank you.
Thank you. Bye.
Bye.
Bye. And the last candidate, that Paride Zuccaro. Paride, are you here?
Yes.
Yes, I cannot see you.
Can you see me now?
Okay, yes, I can see you.
That's my ID.
Okay, Paride is going to discuss a thesis under my supervision, whose title is The Liquidity Discount in Exponential Levy Markets, Evidences from Oil Futures. Okay, Paride, you can share your screen and start your presentation.
Can you see it now?
Yes.
Okay. So as you were saying, I'm going to discuss a thesis about the liquidity discount in exponential levy markets. Since like evidences from real data are few, I decided to focus on a tricky and enticing security, which is that of oil futures. I would start by introducing a quote from Amjad et al. Amjad is like a pioneer in the liquidity study, in the liquidity field. This quote says that there must be an equilibrium level of disequilibrium, that is, an equilibrium level of illiquidity. The market must be liquid enough to compensate liquidity providers and not so liquid that it is profitable for new liquidity providers to enter. So why this quotation? Basically, from here, we can see that liquidity is a source of risk. And as a source of risks, a risk, it comes into the market as a cost. So this cost is borne by investors. This is the first thing that we have to say about illiquidity. Sources of illiquidity are several. We have private information, search problems, clientele effects, and trade restrictions. Private information is like the basis of asymmetric information. Search problems means that you cannot find a counterparty to whom sell your security. Clientele effect is when investors tend to focus on the same security. Like we have the clientele effect when we have the flight to quality, when many people invest in the same security. A recent example is that of a tweet of Elon Musk about Bitcoin, and all the people were investing in Bitcoin. If all the people are investing in Bitcoin, it's more likely that these people are not investing in other assets. And that of trade restrictions. Trade restrictions, it's more pertain to US. For instance, they have like a rule. It's Rule 144, which prohibit investors to sell some specific securities after a certain amount of time. Illiquid assets are many. I've just summarized the most evident ones, which are private equity and venture capitals, real estate assets, especially during periods of market downturns, sole proprietorship, and non-performing loans. I focused my study on modeling illiquidity with options. In particular, I was modeling them with exchange options and in levy markets. Why the choice of levy market, exponential levy markets? Because they allowed me to use the Black-Scholes formula to price the exchange option when doing the empirical study. Also, exponential levy processes are used to describe stocks and general securities dynamics, because they have like independent increments. They are memoryless. So like there are some features which best fit the dynamics of a stock or a security in general. The exchange option in synthesis is like an option which allows you to trade one security for another security, the underlying one for the strike one. In our case, the underlying security is a European call option, which is written on a portfolio, VS, and the strike asset is an American call option written on the same portfolio, VS. The portfolio VS is made of two assets in the general framework, the asset S and another asset which is ET. ET is called the asset replacement dynamics. This asset is basically an alternative to the asset ST, which is subject to illiquidity features. The liquidity premium, as we can see here, is the difference between the American call option and the European call option. Since we know that the American call option can be exercised at any time in time, it's like the optimal time to exercise is when it reaches its maximum value. So it's like the supremum of the expected value. Tau is the stopping time, and the stopping time when the option is to be exercised. I go on. I focused in particular on a specific case of exponential V process, which is that of the geometric Brownian motion. As I said before, this helped me working with the Black-Scholes simulation, Black-Scholes method to price the exchange option. This is the equation that I used to price, and I solved it for specific values of K and ST. Specifically, ST was taken as S tau, so S at the stopping time value, and the K was nothing but S tau times times E power R, which is the risk-free interest rate, T, capital T minus tau. So like from the time minus tau. So basically, from the time of exercise until the time of expiration, it's like mounted. It's it's multiplied to the time to maturity. This method was first introduced by Francis Longstaff in a pioneering paper in 1995. Was further developed in other papers in 2017. The theoretical result of a Longstaff approach consider a unit security, which is whose nominal value is 1, and different values of volatility. and different values of the liquidity horizon. So he's assuming, Longstaff is assuming that the investor can perfectly time the market, which means that he can make forecasts about what's going to happen. By running on my own his simulation, I found out that his result show pretty much what one expects. So if there's a trade restriction of 1 day, we have an illiquidity discount of roughly 0.25%. If this restriction is with a 10% of volatility, if this restriction goes on for 100 years, the liquidity becomes roughly 38%. Increasing the volatility increases also the discount. Why? Because since we have, as we saw in the previous slide, it's the difference between the American option and the European option. By increasing the volatility, the investor perceives that the asset can reach higher values more likely than when it has lower volatilities. So it's a little bit counterintuitive, but it has like an explanation. Also, to summarize, what we see from this simulation is that the higher is the volatility, the higher is the discount, and the higher is the liquidity horizon, the higher is the discount. What I did is to run the simulation, so the Longstaff simulation, on a particular security, which is that of oil futures. As I did, I faced some difficulties to find data. Oil futures is not like the most suitable for security, but I thought that futures in general feature some illiquidity characteristics. In fact, when after a few days from the issuance until they are like 2 years from the maturity, they feature very low trade volumes, and which can be associated with a trade restriction, because in particular with a search problem. Because if an investor purchases an oil future at its issuance, he's assumed to hold this future until it becomes really liquid, so he can sell it to other parties. What I found is that on average, unless like there are very very few cases where there are trades, and these trades are of little quantity, if not before the threshold of the 2 years. Also, we know that the forward spot price asymmetry decreases with time to maturity. These are the results of the simulation that I run. This result here, they bring us the absolute upper bound on the liquidity discount, and we see that in particular the one from a half a year maturity to maturity, with respect to the one of 8 year to maturity, it's kind of almost 3,000 more, the one which is 8 years from maturity, because the investor who was purchasing was expecting to hold the security for much longer. Here, this is the one of the CLZ30, which is the future which expires in 2030. I brought it just as an example because it was issued a few months ago, and it was actually, yes, a few months ago, and it's 10 years from its maturity. This shows us that when it's 10 years from maturity, we have few data points, but the discount applied to this security is 11. The upper bound is 11 with respect to 0.75, which can be considered the future which is closer to maturity. Here we have data which go against our expectations, but since we're working with real data, real market data, there are some market turbulences which are grasped by the model. We will see it we will see it in the next slides. In particular, this brings the percentage liquidity discount. This is the percentage upper bound on illiquidity discount. We see here that during the COVID pandemic, when the oil reached the minimum prices, it even went negative for days, for a couple of hours, we see that the illiquidity discount rises like steeply, and soon after it has become to decrease. And this point here corresponds exactly to the decrease, to the sharp decrease that we had in April 2020. Made exception of this, the path is quite smooth, and made exception also for the few data points, for the few initial data points where the security was really suffering the liquidity discount. Analyzing the discount, we see another important results, that is the illiquidity discount is much higher. The annualized liquidity discount is much higher for smaller maturities than it is for higher maturities. Why? Because when we are annualizing our discount, we see, for instance, this is the graph that reports our result. That the marginal discount that is applied at different dates is decreasing in time. For instance, I take the one from the simulation, which is clearer. If the discount which is applied here, the increment, sorry, that we have for shifting from 1 day to 1 week is lower than the increment that we have from 1 week to 2 weeks. Okay, and here it's more evident because it's 1 month, but in general, it's like it's diminishing in time. The marginal increment is diminishing in time. So I was saying that about the analyzed discount, the results completely respect our expectation and the theory of Longstaff. I will go straight to the conclusion by saying that the liquidity discounts can be modeled in multiple ways. I brought an example with exchange options, as it was suggested by the model of Longstaff, but also from the model of Mattis of 2017. But other approaches are with regressions which consider some market factors and market variables. The evidence from the market confirm our expectation from the theory. So all futures, but in general, futures have some illiquidity features, and in absolute term, this illiquidity, the liquidity discount which is applied to these features decreases with time to maturity. On the contrary, again, in line with the theory, the annualized liquidity discount shows its major impact for closer maturity. Additional studies, which I thought may be useful to do, may concern the impact of economic shocks on liquid securities. Also, because mainly because during this period of economic turbulences, as we saw, there is a flight to quality, and this illiquidity discount may be exaggerated, may be increased. So this being said, I would conclude and wait for your questions.
Thank you. Are there any questions?
I have not a question. I don't know if it's a question or a comment. I read your thesis, of course, and I'm hearing my voice back.
Yeah, we have an echo.
Yeah, okay. Yes, when you were presenting your results, you mentioned that the values you are presenting are upper bound of the discount, the liquidity discount. In what sense they are upper bound?
So I mean that being upper bound, it's the maximum discount that can be applied. Okay. Okay.
Okay, and this is the difference you show in I don't remember the number of the slide.
You want me to share again? Sorry, but I was.
No, at a certain point you presented the difference between the American price and the European one.
Yes.
This is the difference you computed.
Yes, exactly, exactly. So basically, what I did in my study is I took data from Thomson Reuters, okay, and I modeled them with Python and Excel. How did I model them? I simulated a geometric Brownian motion for the stock prices in order to compute a strike price for each option. This option written on a future, on every single future, was priced in European terms and in American terms. In American terms, I used a Black-Scholes model adapted for the American pricing for the American options. In the European option, I simply used the Black-Scholes model for put options. After this, I priced the illiquidity discount as an option, an exchange option on the two call option on the two put options. Sorry. Okay.
Okay.
So,
okay.
This is like the result. There is
Okay. I wanted just a confirmation that I really understand what was the content of your thesis. Okay, you're right. Okay, perfect.
Thanks.
Okay, so thank you everyone. Now the Commission is to leave in order to reach an agreement on the evaluations, and well, we'll come back in a few minutes. Okay?
Okay.
Okay. Okay, so is everyone here, Marco? I cannot see if Sabrina...
Sì, ci sono, scusa, non ho acceso la telecamera, scusa. Ok.
L'importante è che ci siamo tutti. Ok, so we started with the proclamation with two double degree students. So I call Marco Bellini.
Yes.
So please, Marco, turn on your camera.
Can you see me?
No.
It should. I can't understand why it's not working.
It's not working?
Yeah, I don't understand why.
Okay, Marco, can I go on also without the camera? Yeah.
If it's possible, yeah, I really can't understand.
So Marco is Professor Lamandini as an expert.
You can try with the phone if your computer doesn't work.
Yes.
Okay.
Is it working now? Okay.
Yeah, it's working, yeah. Okay, so Marco Bellini, you have taken part in the double degree program at the University of Applied Sciences, Vienna. Given the results of your exam and the discussion of your final thesis, and in accordance with the statutes of Italian law, I declare you Doctor Magistralis in Quantitative Finance with the grade 102 out of 110. Congratulations.
Thank you. Thank you very much.
Congratulations.
Thank you.
Sardina, Francesco. Sardina,
The microphone.
Sardina Francesco, are you here?
Yes, I'm here. Do you see me?
Okay. Yeah.
No.
We see
No.
now.
No?
Yes.
I see him.
Okay, it should work. Do you see me?
No. Okay, now it's fine. Okay, welcome. Spiridone Francesco Sardina, you have taken part in the double degree program at University of Applied Sciences, Vienna. Given the results of your exams and the discussion of your final thesis, and in accordance with the statutes of Italian law, I declare you Doctor Magistralis in Quantitative Finance with the grade 106 out of 110. Congratulations.
Thank you very much. Have a nice day.
Congratulations.
Thank you.
Francesco Bova. Francesco Bova.
Yes. Can you see me?
No.
Yes, I see you.
Yes.
Okay.
So I have problem. I cannot see you. Okay, Sabrina, you can see.
Yeah.
Go.
I see
Okay.
him.
So maybe
Okay.
it's my problem. So I can go on. Okay. Mr. Francesco Bova, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 100 out of 110. Congratulations.
Thank you. Thank you very much.
Congratulations.
Ok.
Congratulations.
Francesca Buonanno. Francesca Buonanno.
Can you hear me? Okay.
I can hear you, but I cannot see you.
I see her.
Really? So
Yeah.
I have a problem. Okay. Okay. So, Miss Francesca Buonanno, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 100 out of 110. Congratulations.
Thank you. Thank you to the...
Congratulations.
Congratulations. Bye. Arianna Carè.
I'm here. Can you hear me?
Yes.
Yes.
Can you see her?
Yes.
Yes. Okay. So, Miss Arianna Carè, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 107 out of 110. Congratulations.
Thank you. Thank you very much.
Bye.
Congratulations.
Bye. Leonardo Gigliotti. Oh, I can see you. Okay. Mr. Leonardo Gigliotti, having
This is digital discrimination.
Yeah, digital discrimination. Right. Okay, Mr. Leonardo Gigliotti, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 92 out of 110. Congratulations. We cannot hear you, but...
Congratulations.
Okay. Congratulations.
Wow.
Sevini Mamudova. Sevini Mamudova.
Yeah, I'm here.
Okay. Mrs. Sevini Mamudova, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 94 out of 110. Congratulations.
Congratulations.
Bye.
Bye-bye.
Bye. Zaka Mamadov.
Hi again.
Okay. Mr. Daka Mamadov, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 96 out of 110. Congratulations.
Thank you so much. I'm grateful. It was an honor for me. Thanks.
Okay.
Okay, thank you. Goodbye and congratulations.
Thanks.
Andrea Saverio Rotolo.
Yes. Can you see?
Yeah. Mr. Andrea Saverio Rotolo, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 106 out of 110. Congratulations.
Thank you very much.
Congratulations. Good luck.
Simone Settimo.
Yes, I'm here.
Okay. Simone Settimo, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with the grade 104 out of 110. Congratulations.
Thank you so much.
Congratulations.
Thank you.
Pari de Zuccaro. Mr. Pari de Zuccaro, having considered your final exam and your academic transcript, we are delighted to award you a master's degree in quantitative finance with grade 106 out of 110. Congratulations.
Congratulations.
Thank you very much. Bye-bye.
Bye.
Bye. So, students, from now on, you keep being part of the academic community, more precisely of the alumni community. So please take part to the event, which will be organized from the University of Bologna, and particularly from the Quantitative Finance Master degree, which involves also your participation. It's my pleasure to invite you to the awarding proclamation ceremony, which will take place as the emergency for COVID-19 will be overcome. I'm looking forward to seeing you in person as soon as possible, and enjoy this day at your best. Thank you very much, everyone.
Thank you all. Bye-bye.
Thank you.
Thank you.
Thank you.
Congratulations to all.
Thank you.
Thank
you.
Good luck. Bye. Thank you.
Bye.
Bye.
Bye.